Pierce Theron Smith in 1974, and then was offered the opportunity to manage the options strategy department at Wheat First Securities. In January 1987, he left Wheat First Securities to start Dorsey Wright & Associates as an outsourced options strategy firm. After the crash, Dorsey realized that the options business would never be the same. He changed the company's focus from an options strategy firm to an equity research company, primarily because any options strategy first begins with researching the underlying stock. Today, the company employs 16 people, with clients spanning the globe in addition to managing over $700 million in assets through separately managed accounts, annuities, mutual funds, and exchange-traded funds. Mr. Dorsey has 34 years of experience in the financial services business and is the author of numerous books on the point and figure methodology as well as motivational books. Mr. Dorsey is an award-winning speaker, having taught the point and figure methodology throughout the world. As always, we encourage you to submit your questions throughout the presentation. However, due to time constraints, we cannot answer them until the end. That said, without further ado, I give you Tom Dorsey.
Well, thank you very much, Shane, and it's great to see everybody sign on here from the MTA. You know, in this presentation, some of it might seem a little bit basic to some of you because I know as you study for your CMT, you have to learn something about point and figure charting, so you may very well be up on this. But what I'm going to do is lead you in a logical, organized way into what I think is the future of investing. And without further ado, we'll go ahead and begin here. And I'm going to start with the first chart that we have. What this is from Ridex Corporation, and it's kind of interesting when you look at the structural bear markets and structural bull markets. In fact, in the structural fair market vernacular, I coined that the market that we're in now back in 2001, a structural fair market. And the reason I said fair is because the previous 18 years were very unfair to short sellers. It was primarily a bull market that went straight up. In this market, we were in a condition in which I believe there would be equal opportunity for those willing to sell short, those wanting to go long. There would be that type of market where you've got to watch very carefully what you do. And we have, in fact, been in that market. How long do we stay here? I really don't have any idea. You look back to the 1896 and you say, okay, when we were in a structural fair market back around October, let's say October 29, when the market crashed, it stayed 25 years. Will we stay 25 years in this kind of market now? I have no idea. The next one lasted 17 years. The least amount of time was 13 years. Will this prove to be the least amount of time? Maybe we're nearing the end of it right now. I have absolutely no idea. What I do know is that we're in that structural fair market now. And that requires much attention from the investor and the advisor who's helping that investor. It's kind of interesting when you think about this too. If you look at, let's say, a 30-year career of a person investing, and you know, when you finally graduate college or you start working and you begin to accumulate some money, you probably have 30 years of investing. And when you look at this chart, you can see that depending on where you step on that train, you may end up getting two structural fair markets or bear markets in your investable lifetime and one bull market, or you may end up getting two bull markets and one bear market. All depends on where you stepped on that train. And I'm sure some people listening here might be more my age, which is about 62 years old. Some of you may be still in your 20s. Look at where you got onto this station here, and that might give you an idea of what your investment career may well be like going forward. Let's go next slide. What's the worst thing that can happen to a quarterback? He loses his confidence. And I'll tell you, most people and many of the professionals that I talked to last year in 2008 have lost their confidence. They've come to the realization that the modern portfolio theory and that they've been teaching their customers for all these years is totally discredited. And they've lost their confidence in what they have believed in for so long. And that's the kiss of death when you lose confidence. 2008 caused Dorsey Wright & Associates to increase our confidence. And we have more and more professionals coming to us now for guidance. In fact, our Stockbroker Institute this last weekend was very interesting. One of the gentlemen at lunch came up to me and said, Tom, you know what I see here? I said, what's that? He said, I see a whole lot of gray hair. And what you had was a lot of older people that came to the Stockbroker Institute wanting to change what they've been doing for all these years. And they understand that tactically they've got to take control of the portfolios again. The separately managed accounts has failed them, and they're back in the business of being in control. And I'll tell you what, some lives changed this weekend, and I think it's fantastic. When you think in terms of supply and demand, one of the things that got me onto the point and figure method was when I started the option department at Wheat First Securities, the first person I hired, Steve Kane, brought with him a little red and white book, and you all know the name A.W. Cohen, written in 1955, and he gave it to me. He said, think about this for a minute. He said, when I come to you with a stock I like or sector I like or the market and whatnot, I want you to understand the template in my mind. He said, I'm asking you to read this book if you would. And that weekend I went down to Virginia Beach with my wife, and I was laying in the bed, and I opened the book and read the introduction to the book, and my life profoundly changed that moment. My wife would tell you that second was the epiphany to me. Some of you may have had the epiphany in your business, I don't know, but it was with me that second when I knew what I was here on earth to do. I knew what I would do the rest of my life. And what this did is hit me between the eyes. After being a stockbroker at Merrill Lynch for about 5 years before that, or prior to taking over the department at Wheat First Securities, I remember that what they wanted you to do is do what you were told, when you were told, how you were told, and then stop. Reams of information, fundamental information just kept coming across your desk. And Wall Street was so obfuscated, clouded, and you really had no idea what was going on. And all of a sudden in this paragraph, supply and demand hit me between the eyes, because what A.W. Cohen said, in essence, was if there are more buyers than sellers willing to sell, price must rise. If there are more sellers than buyers willing to buy, price must decline. If buying and selling is equal, price must remain the same. There's nothing else. You can send that to MIT, have it macerated, put a square root over the top of it, make it as difficult as you want. But in the end, it's the irrefutable law of supply and demand that causes all price change. And that hit me between the eyes because I have a degree in economics. And never once while I was a broker did I ever think economics had anything to do with anything. You just read research reports, you did the fundamentals, you sold the sizzle, and that was it. When in essence, supply and demand had everything to do. So all of a sudden, in 1 second that night, the clouds cleared. If you could just picture, all of a sudden, a breath of fresh air coming into the room, the clouds on Wall Street cleared. I saw things for what they were, and I said, I just found the holy grail of investing. It's the irrefutable law of supply and demand. And as I read further, I found that Charles Dow developed this methodology, and he understood this back in the late 1800s. And this methodology of point and figure charting was simply a logical, organized way of recording the imbalance between supply and demand, where volatility was totally taken out of the picture. Only that battle between supply and demand was depicted. And I said to myself, I've arrived, I'm home, and this is the one piece of the equation that every stockbroker I knew was missing. I knew bar charts and all kinds of Fibonacci retracement and Gann angles and things out there, things nobody really could understand. But this was something that was supply and demand, and I understood it. And I began to get visions, and I started to think in terms of pictures. And I thought, well, when you explain this methodology to someone, one of the easiest ways is when you sit down and you talk about the supermarket. You say, you know something, when you go into the supermarket, you already understand the price changes. You know, you may not inherently think about it, but you really understand it, what's going on. Well, you know not to buy winter squash in the summer, and you know not to buy summer squash in the winter. You know that in July, tomatoes are less expensive. They taste better. They have a longer shelf life than they do in January. And produce comes in and out of season, and everyone understands that. And at some point in time, your portfolio may look like a basket of fall vegetables. At some time, your portfolio might look like a basket of summer vegetables. And whoever you're talking to all of a sudden understands sector rotation. They understand supply and demand. They understand that how you rotate in and out of asset classes. They get it already. They go to the supermarket every single week. And the next picture I show them is the New York Stock Exchange. I said, that's my supermarket. That's where what I deal in every day, where sectors move in and out of favor, where asset classes move in and out of favor. That's my supermarket. And the two are pretty much the same. It's just that we have different symbols in the New York Stock Exchange than you might find in the supermarket. So already you're half there. Charles Dow in the late 1800s created this chart, which is called figuring back then, because what he did is he took the figures of the chart, the stock, or the prices of the chart, the stock, and put them into the chart. And as the stock would rise from 40 to 45, he would just simply write the price of the stock from 40, 41, 42 up to 45. And when the stock began to fall back, as they do, they go up and they go down, he would simply shift columns, reverse the order, and go down one box and write 44, 43, 42, 41, and then continue the same process. And what he found was there were certain patterns that began to develop that had a tendency to repeat themselves. Nothing more, nothing less. And that's as complicated as it's gotten in the last 100 and some years, because the irrefutable law of supply and demand has not changed. In the early 1900s, they changed it around a little bit, though. They said, let's put some zoomies onto this thing. Let's make this really high tech. You can't readily see when you're figuring which columns. It doesn't just jump out at you which columns are up columns, which ones are down columns. So when a stock rises in price, we'll use the letter X. When it declines in price, we'll use the letter O. A buy signal will be where a stock rises to a particular level that formerly forced the stock down, and it comes back to that same level again, exceeds it by one box, we'll call that a buy signal. And on a sell signal, we'll call the same thing where a stock declines to a particular level and finds support. In other words, buying pressure comes in, the stock reverses back up. It falls back to that same level again. This time the buyers are no longer there, and it slips through, and you have your most basic sell signal. So keep this in your mind for those that may not be familiar with this. What a buy signal is a column of X's that exceeds the previous column of X's, and a sell signal is a column of O's that exceeds the previous column of O's. Now think about this for a minute. I could take a seventh grader and say, I want you to create the New York Stock Exchange bullish percent for me. In other words, I want you to calculate the percentage of stocks that are on buy signals on the New York Stock Exchange. And since you now know that a column of X's is the buy signal, if I gave them 2,000 stocks and I said, look to the far right-hand side, and when you see a column of X's exceeding a previous column of X's, stack it over here in this pile. When you get that pile totally stacked, count the numbers of stocks you have there, divided by the total, and you have a bullish percent. So we didn't even go past fourth grade arithmetic right there. And that's as difficult as it actually gets. So keep those two things in mind there. Here's a chart of Apple Computer. What's interesting in many cases, when you look at a particular stock, and the beauty of the point and figure chart is it is clear and concise. It's the only method of technical analysis in existence today that gives clear buy and sell signals. There is no room for subjectivity. What is. In a bar chart, I could pass around the head and shoulders top to 15 of you, and I might get 15 different answers. If I understood Fibonacci retracements, which I'm not smart enough to understand, I would assume we could probably get some different numbers there. Gann angles, the same thing. But point and figure chart cannot. So think about, for a second, what the computer technology has done for us today. If I go back to this chart again here, and you can see how clear and concise it is, and buy signals are always the same, and sell signals are always the same, we can create a situation where a computer can look at this and understand what buy and sell signals are. Now I'm going to digress for a second. One of the things that we created 15 years ago, which is the future. And most people don't even realize that we've done this, but on any one of our charts on our system, you can go to the left-hand side and click comment. Now, what will pop up there first is you may have a human comment that we looked at the stock, wrote a comment on it, but you will always have an auto comment. In other words, we've taught the computer to speak English, and that computer in 1 second can look at a chart, whether it's in Indonesia, Malta, Egypt, Saudi Arabia, Germany, Sweden, can look at it in 1 second, write a paragraph in English, so you would read that paragraph, you would think it was a human writing it, giving you all the pertinent information that you needed to make an informed decision right there, electronically, bang. I don't care if you couldn't even pronounce the name of the stock, the computer system will do it. That's because it's a point and figure method. It's clear and concise. Now that computer section, put that in the back of your mind, because we're going to get to the future of investing up here very shortly. So this chart of Apple Computer, one of the things that we look at is a top-down approach. In other words, if you look at the typical resource allocation for an individual investor, this was done by the University of Chicago, 80% of the effort that they have is put into the stock itself, when the study they did, and they found that 80% of the risk in any particular stock is not the market itself. It's not the stock itself, it's the market in the sector. But they spend 80% of their time just looking at the underlying stock. This is one of the reasons why I think there are so many technical analysis departments that are no longer in existence, because there's so much more to this now in portfolio management rather than the old school of support, resistance, buy signal, sell signal, trading back and forth. Wall Street has gone past that now. You'll find more than likely, and it's my guess, that the FTA is growing more internationally than it is in internationally than nationally, because on the international front, they're a little bit further behind us where we have come as far as investing prowess has gotten to us. So the tactical allocation approach, here's the meat of what we're going to talk about today, is where we've come up with what I think is a unique concept. It's called dynamic asset level investing, where we simply look at the different assets and compare and contrast. One of the things that has allowed us, and I'm going to show you how we do this in a minute, is allowed us to compare and contrast relative strength charts, is computer power. 23 years ago at Dorsey Wright Associates, the rite of passage when you came into this company was that you did the relative strength charts by hand. So if I was comparing IBM to Dell Computer, or better still, back then we just compared like IBM to the Standard & Poor's 500, we would divide IBM by the price of the S&P 500, or the price of IBM, we would get a number. We then would plot that number on a point figure chart, and it was all done by hand because all we had was a Tandy 3000. I mean, that's in the Smithsonian Institute now. That was technology back then. So we did things by hand. In fact, we used to update 2,500 charts by hand every day. We had 5 analysts, and we would update 500 charts, pass that book off to the next analyst. They would pass theirs off to you, and by the end of the week, we would have seen all 2,500 charts, and that's what we did for the longest time because we didn't have the technology to be able to do these things. Now with technology, and we went to the internet. We were one of the first ones to go to the internet in 1992, 93, and we made a commitment to technology, and we are state of the art in that respect now. The relative strength charts that we do and compare and contrast, we do over 500,000 of them a night, and much of that is due to our clients and giving them the tools to be able to compare and contrast portfolios and that type of thing. If I wanted to compare every stock in the Standard & Poor's 500 to each other, it would take me 2,500 charts to do that. You couldn't do that by hand any longer. The computer systems now allow us to do things we could never have done in the past. And the exchange traded fund, which I was a part of in the beginning in 1983 with the Philadelphia Stock Exchange, has changed the world. And I gave a talk at the New York Stock Exchange when our PDP, which is our 100 technical leaders that we trade with the power shares. It's an exchange traded fund. And I was talking to a group of brokers in the boardroom, and I said, when I rang the bell to start trading this morning the first time, I said I effectively end my 32-year career on Wall Street. I said, when I ring the bell the second time, I effectively begin my new career in Wall Street. And I said, this new career leaves behind the old boy schools and the old boy things that we used to do. And I move into a global economy, a world economy where the world is open for business. And the exchange traded fund, which is the most important product created in my 34 years in this business. And this is where I move forward. And I'm just as enthusiastic today as I was the first day that I started as a stockbroker at Merrill Lynch. And I meant that. And here it is a couple of years later, and it's absolutely the same. It's just as true. I can't wait to come to work in the morning. But one of the things that we created here with our relative strengths is being able to compare and contrast asset classes. And with the exchange-traded fund, you almost don't have to go past the asset class to do extremely well in the market. But what we do here is, here's how it's actually done. You have all kinds of ranks. If you look at ranks of golfers, you might see Tiger Woods first, Phil Mickelson, Strickland, Furyk, Els, Rose, on down. Baseball players are ranked, football players are ranked. Everyone is ranked. We do these kinds of rankings with relative strength. And the way we do it, like I mentioned, is with fourth grade arithmetic. If I want to calculate let's say all major sports have a ranking system. The point and figure chart tool is to rank the use of ETFs. So the daily calculation is if I took an index and put it on the top, divided by another index. So let's say I could put up there the oil index divided by the Standard & Poor's index, and I get a number. I multiply that times 100 simply to make it a larger number that's easier to chart. And that equals relative strength. I divide one thing by another, multiply by 100 just to get it large enough so that it charts easier, and that's relative strength. It's that simple. Think about this also. Look at the simple calculation that can be done. The computer can look at this, and the computer can do this. And the computer already knows what a buy signal and a sell signal is. It knows what a column of X's and a column of O's are. It knows all of those things. So it can automatically do these calculations for you. So let's say we took the MSCE, AFE, the EFA, which is your developed international markets, divided by the Barclays Aggregate Bond Index, AGG. And let's go back for a second. Notice I'm putting an index up there, dividing by an index here, going to multiply by 100, same thing. There's just the two vehicles that we're using. And when this relative strength gives a buy signal, and it's in a column of X's and rising, it's saying by the numerator. And as you remember from fourth grade arithmetic, the numerator is the one on top. The denominator is the one on the bottom. Now, when you create these relative strength charts, some of them are more active, and this is where the craft comes in, where the EFA and the AGG are more active in this relative strength calculation. Therefore, I will use buy and sell signals to determine what direction I go. In some cases, the two things you compare are so inactive that changes in columns from one column to the next is what we would use. And that's where the craft comes in, is understanding that part of it. But at any rate here, if we go to where it begins to start in orange, and you look at July 16, 2002, it gives a sell signal by exceeding a previous bottom. You all know that, your MTAs, exceeding a previous bottom. That means you should own the denominator, which is the AGG, because we have EFA on top, AGG on the bottom. So it's saying avoid the EFA by the AGG. And you can see EFA was up 3.59, AGG up 9.23. Notice on the green part, the first green part, that's July 16th, 2003, it gives a buy signal exceeding a previous top. It says, okay, let's change direction. Now you should own the EFA, and you should avoid the AGG. And what happens during this next run up here until the next sell signal is the EFA is up 101%, AGG is up 1%. Then it gives a sell signal, goes back into the orange. Down, we need to buy the denominator. Something is happening here. Avoid the EFA. EFA is down 35%, AGG down 0.9. The next change, that we're still in this change right now, happened in May 29th. Buy signal on the EFA, and it's saying buy EFA, avoid the AGG, and at this point in time, it's up 15.9%. So this just shows you the different changes that take place by that division. As we keep dividing, and we take those numbers, and what we do is we divide, we take that basic mathematics number, we change it to a percentage, and then we put it onto a point and figure chart, and that's how we understand whether we should be in this one simple case, EFA or AGG. That could be oil versus oil service. It could be oil versus basic materials. It could be Spain versus Portugal. It could be anything that your mind can possibly think of. The computer will do it. And we have models that we run all over the world, and my money is in these models, from Sharia compliant models in Malaysia to Indonesia to Egypt. We run these models with this relative strength all over the world. The way we create the dynamic asset level investing methodology, step one is we create the inventory. Use multiple ETFs to represent each of the following asset classes. So look on the left-hand side under the arm wrestling contest. We look at domestic equities, international equities, commodities, foreign currencies, fixed income, cash. That's your aircraft carrier. This is going to tell you where you should have that aircraft carrier heading, whether it's heading 270 or 350. This is the direction your carrier should be taking. And this arm wrestling contest gives you an idea of what we're doing. We want to use, on a relative strength basis, compare one thing to another, and compare them all to each other. So step two, then, we use a point and figure relative strength comparison, is run between all members of the inventory, and each ETF is ranked from strongest to weakest. So that's the general calculation. Which one of these is the strongest, which one is the weakest. Step 3 is we rank each asset class. This is where we go inside those ETFs. And inside the ETFs, the ETF itself is made up of the pieces, the sum of the pieces. We take the pieces underlying it, and we compare and contrast those pieces to each other. And by doing this, we get a cumulative rank. We compare it all together. The computer allows us to do it. You couldn't do this by hand, but the computer allows us to do it, and then we rank them and we give them a number rank. Step 4, we check against the proxy. In other words, when we determine which of the asset classes are the best, the two best, and let's just take the top two, let's say domestic equities and international equities, which is where it is right now. The next thing it has to do is it has to arm wrestle, or it has to be compared against cash. Each one of those, domestic equities must be compared against money market, and international equities must be compared against money market. And if money market trumps it, then money market is in. That's where you should be. Cash under the mattress, or in a short-term of treasury vehicle. So that's the last thing, is that cash comparison and contrast. That's where we get the idea of the DALI, dynamic asset level investing. And the next thing here, we look at the historical correlations. What this chart simply shows you is that things are not correlated. If you look at the MSCI EAFE against the S&P 500, modern portfolio theory would suggest that, hey, all these different asset classes have a consistent correlation to them down at the zero line. But this chart shows you that's absolutely not the case. And as far as the EFA and the S&P 12-month total returns, they're very, very correlated at this point in time. Back in 1997, they weren't correlated. In 2008, all of a sudden, what was supposed to be non-correlated, everything got correlated, and all of a sudden, modern portfolio theory just wiped some people out after the previous decade of losses they had. So let's go on to give you an idea of how our aircraft carrier performed in 2008. So if we start in January 2008, what you see in red there is more of the defensive moves that happened. And this is the part where we picked out the two leading asset classes that would populate level 1 of DALI, which is a portfolio unto itself. And then it has to be compared against money market, as we mentioned. And if money market trumps it, money market goes in. So we start off January 4th, 2008 with money market and commodities. And what money market did is it pushed out international investing. So January of 2008, we let our clients know the play was over for international investing. Although we still have to manage two international exchange-traded funds, the IYE, which is emerging, the IYZ, which is developed markets. We let our clients know that we are going to be driving the bus over the edge of the cliff. We're going to stop it right here and let you off. And a lot of money came out of those ETFs at that point in time. I don't think PowerShares was happy with it, but it's something we had to do because our aircraft carrier suggested the international play was finished. So money market starts out January 2008, and commodities. Next, foreign currencies pushes money market out March 12th. Commodities remain in. Next, on July 23rd, foreign currencies remain in. Money market pushed commodities out. Notice just in time, because in August, commodities became correlated with everything else and collapsed. So you got the benefit of the run-up in commodities from January to there, but without any human intervention, just teaching the computer system to understand what we understand, to see things the way we see things, and to make your decision exactly as we would make the decision if we were doing it by hand, it pushed out commodities and put money market in. October 1st, 2008, money market and money market. October 22nd, 2008, fixed income then pushed money market out, and fixed income did very well for the rest of the year, and money market stayed in. So you can see in 2008, we didn't own any equities whatsoever, none. January 2009, fixed income came back into or stayed in the play, and international equities moved back into the play. So January of 2008, international equities came out. January 2009, international equities came in. So that gives you an idea of what happened in probably one of the worst years around. Here's the S&P 500 point and figure chart, 2000-2009, with the dynamic asset level investing, as we just mentioned to you, the different points of inflection and what took place there. What's interesting here is just look at those two boxes on the left-hand side. You can come back and look at the other stuff later, but I want to move through here. January 2000 to 2003. Notice fixed income was in play in the Daly level 1 for 845 days. Domestic equities was only in there for 116 days for those 3-year period. Commodities were in for 777 days. Notice the market changes. It's like it shifted gears in 2003 to 2008. International equities then punched into there. Notice international equities had no days whatsoever between 2000 and 2003, but international equities from 2003 to 2008 had 1,500 days in there. Commodities had 1,008 days. Notice how domestic equities pushed up to 616 days. They were in level 1. Money market went down to only 120 days during that period. Over here, money market was in the Daly level 1 for 735 days. This is very, very interesting here. So you can come back and look at that and scrutinize it a little bit closer. What do we do then once we look at level 1 and we say, okay, domestic equities are in level 1, international equities level 2. Okay, that's broad asset classes. And I'm going to tell you something right now. You probably don't need to go any further. Don't tell your clients this, but you probably don't need to go any further than being in the SPX or the RSP. Most people have no idea, and I'll tell you, most brokers I talk to during the day, and I ask them, I say, are you aware that there are 2 Standard & Poor's 500s? And the answer typically is, no, I didn't know that. Well, because the only thing you ever see on TV or any talked anywhere is the SPX. But there's an RSP, which is an equal-weighted Standard & Poor's 500. And I put together, and we did a back test and study, what I call the people's portfolio, is what if you just knew when to be in the equal-weighted S&P or the cap-weighted S&P. The returns of both of those are dramatically different. In fact, this year, the equal-weighted S&P has been the play, and the equal-weighted S&P is up over 100% more than the regular S&P. And most people have no idea about that. Now, if you threw in money market there and said, okay, there are times when we shouldn't even be in equities, the returns are astronomical. So in that part right there where it says domestic equities, you don't even have to get fancy. You could just be in the right Standard & Poor's at the right time, and that's probably enough. But you probably would take it a step further because there are ways of being maybe even making more money. And if you click the left-hand side there where it says Level 1 Ideas, that will break it down for you into finer points. What we do is we take all the domestic equity ETFs and rank them on a rank from 0 to 6, and we rank them from the best to the worst. So automatically you can see exactly what has floated to the top. Now what's interesting is in commodities. When commodities are favored, and you think, okay, there are commodities, there's an ETF in commodities that you can just own commodities in general. But when you think about that, what underlies commodities is some very different stuff. I mean, you've got basic materials, you've got steel in there, you've got lead, you've got live cattle, you have pork bellies, you've got grains, you have cocoa, oil, all kinds of different things. So if commodities were populated there, you could say, okay, I'm just going to buy a commodity ETF. Or you could say, where in the world in commodities should I be? So most of this year when commodities were in level 1 Daly, the place really was sugar, lead, zinc, base metals, gold, silver, even better. That's where you should have been in commodities. So you could have taken a choice and say, I'll just buy commodities in general, and you would have done okay. Or you could have said, I'll focus a little bit closer. I'll bring the laser out and find out the exact right place to be in commodities, and that's where you would click Level 1 Ideas. And if commodities was populated in Level 1, it would show you where to be. So international right now and domestic equities are populated in Level 1. When you look at market timing versus sector timing, this is a study that we have done. And just in general, we took a $10,000 number and said, okay, what if we were in, we either bought or hold. If we had perfect market timing, we were always in the market when the market went up. We were always out of the market when the market went down. If we had perfect sector timing, we were always in the exact right sector and never in the wrong sector, and you know you can't do that. Yeah, that's impossible. But what this shows you is that buying the worst performing sector yielded you almost nothing, and you can see here that the best sector yielded you 5 million versus 655,000, and just the numbers themselves show you that really the key is being in the right sector at the right time. The rest is academic. The way we calculate being in the right sector at the right time is we do the same fourth grade arithmetic. Any of you have a grandson or something like that in the fourth grade, they can help you with this. Have them come over to your house and bring their arithmetic prowess with them, and we'll do some division. And what we might take here, when we look at a particular sector, I might take an ETF and just pick whatever sector you want to name there. We'll put that on the numerator. We'll divide it by a benchmark. Let's call it the Standard & Poor's 500. If I'm in Egypt, I would call it the CASE index. If I'm in Malaysia, it would be the Malaysia market, and so on and so forth. But I'd take a benchmark and divide it into a sector, multiply it times 100 again to get the number larger so it's chartable. What we'll do then is change it into a percentage and plot it on a point and figure chart. That's simple. And what happens then is, like in the First Trust Materials Alphadex, FXZ, we're comparing that to the Standard & Poor's 500, and you can see how the column changes are the most important here, because on this chart going back to 1996 to 2009, there aren't many changes. So when it changes from one column to the next, that's the important consideration. That's where the craft comes in to know when you should fine-tune it a little bit more in this respect. But the point is we're dividing FXZ by S&P 500. We come up with a number, change it to a percentage, put it on a point and figure chart, and it turns into a relative strength chart, a sector relative strength chart. So you can see the returns right there, and I'm going to save time and go to the next one so you understand what we're doing here. We're taking a sector, dividing it by the S&P 500. The First Trust sector rotation model. What we do in the First Trust, which is many of our clients really like this, and one of the reasons they do is because First Trust is equal weighted, and the places bend to be equal weighted. So we invest only in those sector ETFs from First Trust whose RS charts are in columns of X's versus the S&P 500. So that division we just did just now, as long as it was in a column of X's, it'll be in the mix. We equally weight them because that's what First Trust does. We only rebalance the portfolio when an issue moves in or out, and that would be on a relative strength chart basis. The turnover can vary based upon the volatility of markets. 2008, things would be volatile. 2007, less volatile. 2006, less volatile, and so on and so forth. Because the average relative strength column of X's or O's lasts over a year. So that's what I was talking about before, that technical trading. In fact, I almost wouldn't even call what we do technical analysis any longer, but the average time lasts over a year. We're talking about investing. We're talking about building wealth here, not trading back and forth on a technical basis. While the portfolio remains 100% invested at all times, there is risk management with the sell discipline. So the sell discipline, when something reverses into a column of O's, it's taken out of the portfolio, and so forth. So you could also have other parameters of risk management. If the dolly moved into, let's say, a cash position versus U.S. equities, you might say, look, I'm going to pare back my First Trust rotation by 50%. There's a multiplicity of things and many, many right answers that you as a professional and as a market technician will understand, whereas your basic broker is not going to understand it at all. The basic broker is going to create a strategic allocation pie, rebalance the pie, let's say on Cinco de Mayo and the person's son's birthday, and we'll sell the good stuff, we'll buy the bad stuff, and that's as far as they go. You need 5 or 6 or 10 other right answers to deal with. The First Trust sector portfolio looks like this. You think, boy, there's a lot of sectors in there. Well, one of the reasons there's a lot of sectors in there is because every sector basically has been swept up by this market vacuum cleaner that's been sucking everything up. So what we've done recently is really cool. We've gone in here and said, okay, what we're going to do with all of the First Trust sector rotation portfolios is we're going to cull this down to the 5 best. So now we have a guided portfolio for you for the 5 best. And I use the term guided portfolio. I think this is the future of investing for professionals because it keeps you in the game. If you can learn what we do, embrace what we do, then we have all of the ETF providers have come to us and commissioned us to create and manage models for them. You have all of these models available to you. In fact, you have everything that we have from around the world, right down to stock models and sectors, where you can look at a person's portfolio, and let's say I came to you and said, I want to give you $500,000, let's get invested today. That's my parameter, let's go today. Well, you might say, okay, Mr. Jones, here's what we're going to do. Tom, I'm going to go into the Vanguard market position, and I'm going to put you into 40% our Vanguard model. I'm going to put you in 20% the iShares country rotation model, which will keep you in the 5 best countries in the world. I want to put 20% in the PowerShares commodity model. I want another 20%, let's say, in the First Trust 5, the best 5, and so on, until you have populated my portfolio. Once you have done that and decided what percentages I'll have of what models, then we automatically keep you abreast of any changes that happen in that model. The beauty of this is we're giving you your life back. So when you embrace our way of thinking and you can articulate our way of thinking, all you have to do is go out and get more money in. The system will manage the models for you. You'll do extremely well. And I think with commissions and fees that continue to be compressed, you need to find ways of getting more money in and developing more business. And this is a way to do it. But I'm going to tell you something. Don't go whistling past the cemetery. And I'm telling you the reason for that now. If you go to mint.com, www.mint.com, you're going to see a virtual financial planner. I put my daughter on this system, and it's fantastic. It keeps her abreast of everything from the equities in her portfolio to if she overspends going to McDonald's, or if she bought too many clothes last week, or the whole thing. It's already the financial planner. It's her personal trainer with finances. At what point in time would you be able to find models that can be run on there? What we have done is we are in a joint venture with Susie Orman, and we have created a retirement program with 3 models, and this can work with TD Ameritrade for even the smallest investor with $100. So believe me, technology is beginning to change the world here. So you've got to become a craftsman. You've got to let technology play into your world, and you've got to find a way to get your life back so you can develop more business. If I go to the ETF, this is the ETF First Trust sector model. We have been able to basically single QSIP for us. The numbers on the left-hand side are the percentages that we create for the chart. So that won't mean much to you. But it's kind of interesting, April 9th, I always find this interesting that The Economist, I don't know if there's anything worth reading inside The Economist magazine, but the magazine covers are just phenomenal. You can always go exactly opposite the direction that they have on the magazine cover. Over a year's time, you'll be dead right. And here's one where it's talking about a glimmer of hope, and down this little red thing here is basically saying, if you have a glimmer of hope, you're about to get eaten up here. And that was April 2009, and you know what's happened with the overall market. So always, whenever you go to the major magazines like Time Magazine, Newsweek, The Economist is a great one. Look at the cover. You don't need to read anything that's inside of it, but just look at the cover and go the opposite direction. We use a three-legged stool, and I don't want to take too much more of your time, but we're getting close to the end here. The three-legged stool concept is we use a dynamic asset level investing for two legs of the stool. Right now it's domestic equities, international equities. The third leg of the stool, we utilize the New York Stock Exchange Bullish Percent Index because many of your customers in America want to have exposure to U.S. equities. So we allow the Bullish Percent Index to guide us on 1/3 of the portfolio for domestic equities. And then we look at the playbook. The playbook would be what plays should you be running at different levels of the Bullish Percent Index. You're going to run different plays when the Bullish Percent Index is at 70%, pretty much where it is now, versus different plays that you would run if it was down at 30%. These are things that you can learn, come onto our system, learn it, and it'll help you become much more successful in your investing. But the three-legged stool is the dynamic asset level investing, level 1 and 2, and level 3 is the domestic equity exposure with the New York Stock Exchange Bullish Percent Index. Many of our clients and professionals don't go past level 1 and 2. This is what they do now. Level 1 and 2, and then they populate domestic equities the way they want to, international equities the way they want to, and there's a multiplicity of ways to do it. Like right now, international equities is in play. Well, how might you do it? Well, you could look at the iShares country rotation model that we have, that at this point in time, when we put this PowerPoint